Hello, everybody, and welcome to Wall Street Hackers, one of the most popular shows on the Pod TV network. I'm Nick Pellavita. I'll be your moderator for today's show. For those who are watching on our mobile phone or you're watching on your desktop, which most people do, you can actually see us on the TV Roku. All you have to do is go to Roku, type in Pod TV, and we have 4 channels that you can watch with a lot of different types of content. So I do invite you to go to Roku. Most smart televisions have it. Type in Pod TV and you'll be able to see this show on Roku. So with that, we're going to introduce the hacker himself. He received a bachelor's degree in economics from UCLA. He also received a law degree from the University of Miami, a master's in business administration from NYU, and spent 17 years hacking up and down the Wall Street. And with that, he's going to bring the topics that you're used to seeing now, the markets. Also, we'll see the quotes of the weeks, the stories of the weeks, Peter pick, and the panel discussions, all within a very short time, 30 minutes with very little commercials. So with that, we're going to bring in the hacker himself, Peter Bennett. Peter, welcome to your show.
Hi, Nick. Hi, everybody. We're back on Wall Street Hackers 2824. And so we start always with our welcome and say that you can catch a new episode of Wall Street Hackers most Thursdays or Saturdays, depending on your distribution channel. So the markets. Number one, investors were a little shocked, especially for one day when Fed Chairman Powell said he is in no hurry to raise interest rates, to lower interest rates, to act on interest rates, sorry. And as we've been saying for years, he shouldn't be in a hurry because inflation is not under control. And even worse for the delusional market that still believes now 5 rate increases. A little while ago it was 6, but then March came around it's coming around and they said, oh, no, it was 80% chance of a decrease. Now it's very small and it's not going to happen. So basically, U.S. jobs growth totally blew past consensus in January. U.S. non-farm payrolls were up 353,000, and that was against 170,000 expected. Even worse, average hourly earnings was up 0.6%. First of all, 0.3% was expected, which would have been at least holding steady. But at 0.6%, that's a 7.2% wage increase rate annualized. Unemployment came in at 3.7% against 3.8% expected. And it has slightly moved from 50-year lows, but we still have roughly 9 million unfilled jobs. Where all of a sudden is the market tightening? When the consumer has money, and that's a good thing, obviously, but they're going to keep spending. So, the Fed wants to fight inflation with no pain, and it's probably not going to happen, unfortunately. And then energy, one of the big 3 reasons why I'm not confident at all in what's going to happen next is energy contributed a lot to the declines in inflation from June to the end of last year. But that's not necessarily going to help and probably going to hurt. Not only are there very well known tensions in the Middle East, everybody knows about the Red Sea and you hear all about that, but people aren't paying attention to the drone attacks on Russian oil supplies. And that is underappreciated because that actually could have a very big impact on the oil market. And then also the U.S. is reimposing sanctions on Venezuela. And that had loosened up the market a bit. And now, because the Maduro government said, well, the leading candidate cannot run at all. At least that's going to happen in Venezuela, but it could never happen in the United States because it would be in the name of democracy, and that could never happen in the United States. So the only good news on inflation fight is that we're finally seeing one indicator of some progress, and that's in rents. So based on new government data, a new tenant rent increase was actually down by 4.7% in Q4 23. And that's the first decline since 2009 in rents. And Wall Street Hackers has been saying and said probably 2 years ago, this will be the first sign of the fight against inflation, because rents will go down with interest rates so high, and things will slow down. The consumer will get squeezed, unfortunately. There's a lot of reasons why rents are going down. About half of U.S. tenants say they can't afford, or they're struggling a lot with their rents, unfortunately for them. So there are supply and demand issues on that side. And then also the supply of multifamily housing has increased a lot since 2022. And that 23 increase in multifamily housing is why we pulled away from the apartment REIT sector, because I still like it, but it's not particularly value now. And I think there's better opportunities. There's a lot of new apartments, especially in the South. And we had very recently, I think I quoted last week somebody who said that the rent market in the South, their company's feeling it. So it's not a bad place to be, but it's not where I would be at all right now. So the first shoe, at least in the fight against inflation, has fallen, and that's at least a start. Again, 2 years later, but there is a long way to go to the Fed getting anywhere near the target of 2%. And the problem is, as I've said forever almost, that the Fed is going with higher for longer, but not high enough for longer. So it's going to be a long, protracted process. And who knows? Inflation could be around for 5 years or 10 years. I hope not. But it's definitely, I don't think it will be, frankly. But in the end, I think the market is not discounting what's going to happen in terms of the Fed may not be doing a lot of decreases. And I think the market has built that into the pricing. As a matter of fact, I heard on CNBC today, somebody said that there might not be any decreases in the Fed rates. I think for political reasons or for whatever reasons, the Fed will loosen up. There'll be some pressure on them, not just politically, maybe in their thought process. So maybe they'll do 2 rate decreases this year, but I wouldn't even count on that, because inflation could get worse. We'll see what happens with energy, unemployment, and of course government spending that is totally out of control in terms of they're printing money, and it's an election year, so neither party will do anything about that. The overall result will be, for the investors, a very flat market in our prediction, maybe a 4 or 5% if we're lucky. And that brings me to the key point of, in the last 2.25 years, the market's gone basically nowhere. You will hear, I saw it on the same CNBC share today, oh, the market is up, to new highs. And it is up to new highs. And it's been up to new highs many times, at least 7 times in the last 2 months. But it's going up by tiny little bit over that high. If you look at the actual numbers, you're looking at less than a 2% rate of return for 2.25 years. That is an abysmal rate of return against inflation, which was higher. And it doesn't even count the fact that if you're earning 2% or whatever you're earning, you're probably paying capital gains taxes or dividend taxes. So you're losing ground in the market. So it's so important to be selective. And I believe in our portfolio. We'll just keep giving you dividend ideas. And I think we've done very well over the last 2 years, and we'll see where we go. So quotes of the week, I have 3. 2 of them come from Barron's Roundtable, the 27th. So it was 2 weeks ago, but I didn't use it last week. It was from somebody named Rajiv Jain. And his first quote relating to the markets is, the business risk in China is quite high, and government intervention has led to significant derating. You don't want to argue with the Chinese Communist Party. His point was China's going to stimulate now and probably for a long time, because they have a real problem with their property market and some other issues, and they need to stimulate. And that is going to drive up Chinese energy supply demands. Sorry, again, I don't know why I did that today. That's going to drive up energy demand in China. And so that's one factor. When it goes back to normal or higher, that's going to drive up oil. His second quote is, and we totally believe this, energy should be a core part of any portfolio due to the underinvestment in the sector. I'll pause a second. I've been talking about that for years. the sector is investing less than half of the capital they used to invest in into oil and gas projects. And the reasons are because of ESG projects, which are taking up 10% of their capital budgets, because of governments around the world stifling what they can do, and because if they're in a terminal business, maybe they want to return more to shareholders in the form of dividends or buybacks. And that makes sense. If your business is even potentially going to end in 20 years, you're going to be a little more conservative. So he goes on, global demand continues to creep up, and it does. The ESG, environmental, social, and governance bubble has popped in stock markets. Ground reality has begun to sink in. Exactly. So, I mean, there's reality and what people say about it, and it can be very different. Finally, from Richmond Fed Reserve President Tom Barkin this week, he said, quote, "It makes sense to be patient on the timing of interest rate cuts in 2024. He was saying he isn't worried about investors or the markets having different forecasts from central bank officials. That's what we've been saying for a while. There's an expression, don't fight the Fed, and everybody always says it in the market. Don't fight the Fed. We've heard this for decades. Don't fight the Fed. But all of a sudden, the market's decided it's going to fight the Fed. So I'm not quite sure how that's going to work out, but I wouldn't fight the Fed. And the market, again, is saying to the Fed, oh, just loosen things up and it'll all be good and we'll all be great, no problems. But the reality is the Fed has to deal with inflation. So I don't think there's going to be 5 rate cuts. They were predicting 6, but we'll see where it goes, but it's all priced in. So even with the S&P up this year, you have to be very selective in your investments. That's the bottom line. 5 most interesting stories of the week. Number 1, the biggest problem with the Senate proposed border security bill is it does absolutely nothing for border security. It would allow up to 5,000 illegal encounters per day before anything is done at all. If you just go 5,000 times 365, that's over 1.8 million people additionally crossing the borders per year. But that figure doesn't count the getaways. So we're only talking about encounters, and the getaways are substantial too. And even if the 5,000 per day was exceeded, the bill gives President Biden and Homeland Security Mayorkas, Secretary Mayorkas, discretion on certain actions. So I'm not counting on that, given their former, for the last several years, policies that have encouraged basically immigration. So it's basically a politically oriented bill. And I don't think anything will probably be done on the border this year, but we'll see. But here's really interesting context. President Obama's Homeland Security said over 1,000 encounters per day would be a crisis. Let me repeat that. He said the Homeland Security for President Obama said over 1,000 encounters per day would be a, quote, crisis. A little contradictory question. Is 1,000 a day a crisis, or is over 5,000 a day acceptable? You tell me. Number 2 interesting story. Top U.S. investors have been secretly investing in China. Nearly half of the most powerful players in venture capital are quietly investing billions in Chinese tech startups rather than U.S. competitors. They're taking in massive returns at the expense of American national security. At least 46 of the top 100 investors on Forbes' 2023 Midas list have direct connections to China. They're helping Beijing beat Silicon Valley in the race for the next big tech breakthrough. A fellow named Andrew King, who is the Future Union founder, said, quote, "Those investors laid the very foundation for our foes, innovation ecosystems and the technologies against which U.S. companies and democracies now compete. In some instances, the sole reason for the investors' inclusion on the list was their investment successes in China. Many, by the way, were born or educated in the U.S. So basically, these companies are making money in China and dramatically hurting U.S. security. Interesting story number 3. Last week, I promised, Wall Street Hackers was going to predict who President Trump was is going to choose as his vice president. The story won't be quite as powerful now, and I'll explain why. But basically, we were going to say it's either going to be Tim Scott or Kristi Noem, and we're pretty sure of that. And at that time, there was nobody else saying those are the two. But President Trump just gave an interview in this last week in which he name dropped only two names, those names, Tim Scott and Kristi Noem. So it could be either one. Tim Scott and Kristi Noem will help with certain sectors, basically, of the popular will help with certain votes. Basically, Kristi Noem might help with suburban women, especially, and Tim Scott might help especially with the black vote. But if I had to pick, I think it's going to be Tim Scott. The reason is kind of strange, and I think either would help him a lot. And they're big advocates for freedom, well-spoken, bright people. But I think what he's going to think in the end is, they called me a racist, and I'm going to prove they're not. So that's why I picked Tim Scott as number one, but Kristi Noem is a close second. Anyway, all that was said before it was in the news, and Trump mentioned those two. And we're still not really sure. Interesting story number 4, we'll go with. Higher education is facing a very serious reckoning. Many employers are fed up with the waste of college and are opting for either blue-collar workers instead, or they're saying even for professional jobs now, they're not requiring college degrees. Now, it's also a tight job market, so that's a big factor. But according to the Wall Street Journal, nearly 50% of parents say they will not send their child to a 4-year university. 50% now. And 2/3 of high school students believe they would be fine without a college degree. So colleges, push this kind of educational agenda on people. The prices are gone through the roof, much faster than inflation for decades, partly, by the way, due to federal funding, allowing big student loans, and the colleges spend and spend. And there is probably going to be a day of reckoning for many of them. Next interesting story. Beverly Hills home renovations are now blocked over a lack of affordable housing. So Hollywood's elite may no longer be allowed to upgrade their residences until they address a lack of affordable housing. A Los Angeles Superior Court judge alleged that the city has failed to follow state laws requiring a plan to build low and middle income housing. The ruling will temporarily suspend Beverly Hills' ability to issue any permits. So in other words, they can't build new swimming pools, fix kitchens, fix bathrooms or gyms until they fix this issue. And as an aside note, the Josh Altman, who is $1 million listing realtor star, is arguing Beverly Hills has no room for affordable housing. I guess not, if he says so. Anyway, we'll take a quick break and we'll be back with the pick of the week and the discussion of the week. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you in your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
And we're back. So what to do, as always, it hasn't changed for 2.5 years. One, own pipelines and energy. I think especially pipelines give you almost perfect safety. I mean, there's never a guarantee, but it's the only place I know where you get high yields, growth, and relative safety, almost maybe perfect safety because of demand pull. Also, just energy generally, I think, is a place to be. Number two, have any stock allocation you have in stocks, have any allocation you have in stocks in dividend stocks. Why? Well, our favorite chart shows that for 50 years, from 2022 until 2022, for 50 years, dividend stocks got double the return of the S&P 500, and dividend growth and initiator stocks had triple the returns of the S&P 500. So that is phenomenally better. And I believe the next 50 years after 22 will be the exact same as the 50 years to 2022, because dividend stocks offer so many advantages, steady income. They're also easier to hold. So if they go down in value, the dividend rate actually goes up if the dividend holds. And also, it just feels better. It's like, okay, I'm still getting my dividend. I'll just wait it out. So I think since the mentality of many investors is when it goes down, oh, I'm panicking, I'm selling, that's established. It's one of the big mistakes that people make. As a matter of fact, a Fidelity study that was very interesting said that they looked at people who were deceased and they outperformed their regular clients. And that's because the regular clients were buying and selling at the wrong times, basically reacting to news and things like that. But with a dividend stock, hopefully you hold it, find the right one and hold it for life. And number three, you have to really be selective about the sectors you're choosing now. It's a very challenging market. We'll see, but it hasn't really gone anywhere for over 2 years now. And it's been negative against inflation. So you have to be careful. So income picks of the week. I've never done this before, but hey, Nick, I'm going to mention two. One, EPD is Enterprise Product Partners. And we've mentioned that because it's our second favorite basically investment MLP, only second to MPLX, which is not to be confused with MLPX. They're two different things. We're going to compare MLPX this week, but MPLX we love, and you can look at the performance on that one. But EPD is solid, and also MLPX we recommended a small 0.5%, little more in last week. So first, disclosures, there's no guarantees. These are only our opinions for entertainment only, of course, and consult your financial advisor. So basically, looking at MLPX and EPD, they have a lot in common. They're both pipeline oriented. Again, demand pull is one of the things that make it safe. These pipelines have long-term contracts, and people need oil and gas to run their houses and their lives. So it's probably not going to change a lot in terms of the demand. If anything, it might probably going to go up, especially worldwide. So they both have very large price over cash flows. We love to look at that price over cash flow, and that creates what's called a cash flow yield, and they're very, very high. I mean, you can't get those kind of cash flow yields in many investments these days at all, except for really risky ones like mortgage REITs or other things where there's a lot of risk. They both offer just high general yields, and they both offer tax advantages, which are a little different. The EPD has a K1, and if you have a lot of those K1s, it can cause you accounting expense, and that's one thing people don't like. It's more complicated, but it gets partnership tax treatment, which can be phenomenal. you get all kind of depreciation and depletion, and then you get return of capital. So you might not pay taxes on that for a long time if it's held outside an IRA, particularly. And then MPLX has a lot of, LPX has a lot of advantages too. It has some return of capital and dividend tax treatment. So it's not bad. I like EPD better, by the way, because one, it has higher yield, and two, I think its growth prospects are better. But then again, MLPX has 25 different companies, by the way, including MPLX and EPD. So, I mean, I think it's solid. It's just another little piece, since I only have about 0.5% in there now. So it's both good, but MLPX for diversity. But if I'm going to make my big bet, it'll be on EPD. And I raised my allocation this week, which, as I mentioned, it to 4%. It's just really hard right now to find anything. The muni market has just dried up in terms of getting long duration interest rates. I was thinking of buying a muni bond with some money, and all of a sudden it's like you can get 2.6%, and it was hard to get any duration to 2030. I mean, that wasn't like that a month ago. So there's going to be a race for income as we get it, as time goes on, very likely, and especially when the Fed finally gets around to dropping rates and the economy finally feels the effects of inflation, which it will eventually. Next week, by the way, I'll give you something new. I'm going to go with, give you not a big allocation right now, but my first tech recommendation in some time. And then we'll get back to either non-energy picks or a small few interesting energy picks after that. So we get into the panel discussion of the week. Nick, you can come on if you're around. So this is a difficult but very important issue. And the question is, should the U.S. be doing more mining or remaining the same in terms of what we're doing today? Background, and there's a lot of background. Number one, I was really surprised by this. Despite their name, rare earths, along with lithium, copper, cobalt, and other resources, which are key to securing a greener future, are actually not so rare at all. It's actually a misnomer. They're not rare. There is a lot of these minerals, even in America. On the other side, and I have to give credit first to somebody, because this is based on a lot of information from a journalist named Ernest Scheider, and he wrote a book, which sounds really interesting too. It's called The War Below: Lithium, Copper, and the Global Battle to Power Our Lives. So I haven't read it, but it's probably interesting for people who are interested in that subject. So anyway, so there is a lot of these minerals, but as most people know, mining is loud, it's dangerous, and it's very disruptive to the environment. Whether land should be dug up in an attempt to diffuse climate change is one of the defining questions of our time. If we do nothing, and we keep needing these minerals, that would be ceding the land to China. And that would leave the US forever playing catch up in a huge financial area. Supply chains in the US would remain vulnerable, while the energy transition could actually be delayed. And so that's a big concern. And as a matter of fact, the world sits on supplies of minerals all over the world. There are these, quote, rare earths, which aren't that rare anymore. But as an example of what's going on, nearly a dozen mines in America are being fiercely contested. Plus, there are current regulatory processes in place around the world, which make it extremely complex for mines to be developed, and they remain deeply unpopular and politically polarizing. There have been no new mines for lithium, copper, or cobalt, or any materials critical to America's energy transition approved by Washington in decades. The entire rare earth industry is now located in China, and American car makers and defense contracts are also beholden to a country that has been increasingly adversarial to the West and to the United States. A perfect example of this complexity of this issue. And I was really amazed by this. So on one side, the Biden administration is doling out very large loans to lithium mining projects. And another department in the Biden administration is holding up those projects. So talk about a contradiction. It is a difficult issue. I can't totally fault them. But the question is, it is not clear that this is a Democrat or Republican issue. This is a complex issue. And it's not a conservative versus liberal issue. So, Nick, give me the answer. I'm kidding. Should the U.S. be doing more mining or remain the same?
Well, that just depends, but I would vote generally for more. I just happened to get involved when I was at Carolina Trace Country Club with a mining operation about a mile away. And our club was crazy about it. They spent $750,000 to try to get rid of the mine. So I did a lot of research on it, and frankly, here's the reality. It's relatively clean and safe today.
It was?
In other words, we fought them off because we just didn't want the mine in our backyard. But if you look at the technology on mining today, Peter, it's relatively safe, clean. Reclamation is good. In other words, there's no reason not to.
See, I didn't come up with that.
Even though I was fighting them, because I was fighting them, I was looking at their arguments, and frankly, their arguments were pretty strong. They actually lost at the lower court at the administrative level, but won and had it overturned at the appellate court. But by the time they were done with all the fighting, they just basically gave up and they didn't do anything. It was a quarry about a mile from Carolina Trace. Okay,
this is something I don't know actually, but
well,
it's really
you can do your research. It's absolutely
it's very interesting. So, Nick, do you think that based on what you're saying, and I can look into this more. I mean, I'm not making the decisions obviously anyway, but are you saying that even like if they're doing like mining out west in these big strip minings, they can reclaim them so in the end,
it's really sad because I was advocating to get rid of them. As I did my research, I realized that I was basically wrong, but our country club didn't want them there. Okay, because the last thing you want.
Of course, who wants mining next to your property? Exactly.
It was a mile away from our country club.
Well, exactly, and that's my conclusions. But if that's true, and it sounds like it could be, then your conclusion is much stronger than mine because I'm like in the middle in a lot of ways. But my conclusions was one: if you want a green energy transition, you can't let China do it. This is the obvious one. I mean, you can't let China dominate the total industry. It won't be good economically. It won't be good in terms of vulnerabilities. So either you have to decide, do you want the energy transition or not? And number two, let me give the three and then we'll get back into it. Number two, pollution in China is just as bad as pollution in the US. And that's true in manufacturing too. So it doesn't make sense just to ship it over for political reasons. You might as well have it here. And we are actually in the United States more cautious in terms of the environment and manufacturing. So it actually hurts to ship it to China. And number three, just like in Medicare and Social Security and in finance in general with the deficits, the U.S. has to start thinking longer term and strategic planning. You need long-term strategic planning. You need it. You can't, companies do it. Look, companies do a 5-year plan, sometimes a longer plan. You don't just say, okay, let's deal with this month's budget. You have to look forward to plan where you're going. If you don't know where you're going, how are you going to get there? You have to think about the future. So I understand the political realities, for both parties. It's hard to tell people we've spent a lot of the money that's going to go into Medicare and Social Security. We need to do mining. It's actually maybe what you're saying, Nick, that it's good for the environment. It's not bad for the environment, and it's good for our interest.
The environment. I mean, I looked at everything.
Not as bad.
I was looking at all the arguments to try to get rid of the stupid mine.
Really?
Water's going to be contaminated. No, not really. The air is going to be contaminated. No, not really. There's going to be hellfire and destruction. No, not really.
And what were they going to do? Just like
yell and say we don't want to mine. I mean,
what they were going to cover it up at the end? Is that the plan? Like in the end, they just fill it in with soil and plant trees or something?
Yeah, it's really sad. So if you're objective on it, Peter. By the way, the contested mines are all like ours. They're near city centers. So he said 82. Well, those are 82 mines. Most of the mining is way out in the desert. No one even knows.
Oh, I know that. Yeah.
Okay, so. But really, you have this mentality, this hey, you're destroying the government, the environment mentality that doesn't really look at the facts because you just go, they're destroying. No, and And it's really sad because my first inclination was, oh, it's got to be bad. It's horrible mining. Are you
Yeah,
kidding
that
me?
was my inclination. I had no
Then
idea.
as I went through all the scientific studies, I'm going, wait a minute, it's much ado about nothing.
Right.
So all I could do is argue, attorneys are going to argue for your side and just
Sure.
hope that no one shows the other side.
Yeah, that's true.
Because
Yeah.
the other side always-
So it's interesting. It's possible, and it sounds like from your research, and I know you're a
Yeah.
good researcher, it sounds like what happened is we know it used to be really bad for the environment. The companies would strip mine the surfaces, leave them barren, and you'd see pictures of gigantic mines, big holes that were left barren that were now deserts, where maybe something was there, but it sounds like with reclamation and with
technology.
so again, I think America has to at least consider these facts,
Right.
because we're, again, long-term thinking, you have to look at reality. It's not just about
Right.
politics. You have to look at both on the deficits, which I always talk about because I'm so concerned when I heard it, I'll make one last point. Today, somebody on a financial show was saying, oh, I'm concerned about the 33 trillion in deficits. Like, you're in finance. Don't you know it's really 125 trillion? Stop saying 33, because add the unfunded liabilities in there for Medicare and Social Security, since that's money spent and the government owes it. And that's an IOU that's going to come due.
Right.
Well, I'm
By
concerned
the way,
about
that's a bigger and realistic threat compared to mining. Mining is
Well,
more a
right.
cause right now. And
Well,
it's really sad. Technology has advanced. Just like saying, yeah, I'm not going to fly in planes because planes crash all the time. Well, they did in the 20s and 30s. But today it's kind of a rare event. So, it's the same thing, unfortunately, for all the environmentalists. They can grow up their cause, or you're destroying the environment, but it's just not
Right.
true.
Yeah.
And I'm really sad to report that, because I was certainly in favor of getting rid of that mine, baby.
Well,
but,
really interesting, Nick. We didn't rehearse this either.
I guess
so-
I just go do your research, and you're sitting there scratching your head. You mean
Right.
the air doesn't get contaminated? No, not with this reclamation. Oh, the water? No, they have this other process.
Nick, one last question.
After
What
all,
were
I
they
had
going
nothing to argue.
What were they going to mine in that neighborhood? What, like, materials?
It was just going to be like gravel mine or something.
Oh,
like
okay,
that.
so it was a stone mine. Yeah.
Yeah, and it was a multi-million-dollar process. The guy developed. He wanted to sell it to Martin Marietta. That's what we figured, because he
Okay.
didn't have the financial capacity to really develop it. But then Martin Marietta didn't want to buy into this big hullabaloo. But my research was going like, wow, if this went to a scientific process, we would actually lose it. And
Right.
I was trying to figure out, well, then there was nothing wrong with that. So how could I argue? The only thing I could argue is that they had big trucks. They were going to put 400 trucks a day on the highway. And that's the
Right.
only argument we had. The trucks,
Right.
if they came through our neighborhood or close to it, could have an auto
No,
accident.
interesting. You know what? We'll have to look at other materials too. But so to conclude, because we're really out of time, it's interesting because these two issues almost cross, because the U.S. has huge deficit. The world has huge deficits for unfunded liabilities. Other countries are in just as bad a shape. They promised free healthcare. And so the thing is, you have to increase productivity and help the economy to get ready for this crisis that's coming. You have to do everything you can to be efficient and increase GDP and get ready for having to deal with this debt. So, and it just said 10 years, but it's going to be sooner than that. So, but let's hope that they don't wait till the day of the crisis. So thanks for watching Wall Street Hackers. We'll be back next week. As always, as Kim says, get healthy, get wealthy, and see you soon. Bye, Nick.
See you. Bye-bye.